There is a tax strategy sitting right in front of most Canadian retirees that almost none of them ever use. And over the full length of a retirement, it can keep tens of thousands of dollars, and in many cases, well over $100,000, out of the hands of the Canada Revenue Agency and inside your family's pocket instead. And the reason almost nobody uses it is not because it is complicated or requires any kind of financial wizardry. Because it does not. It requires no loopholes, no offshore accounts, no special products, and no advanced accounting knowledge whatsoever. It comes down to one single question that you have probably never been asked directly before, which is this: which account are you pulling your money from right now? And more importantly, why are you pulling it from that account and not a different one? Because the answer to that question and the specific order in which you draw from your registered and non-registered accounts throughout the years of your retirement is the single biggest lever you have remaining to reduce the total amount of tax your money will ever face across your entire lifetime. And most Canadians are pulling that lever in exactly the wrong direction without ever realizing it. And the cost of getting it wrong does not show up as one large, obvious bill that arrives in the mail and forces you to pay attention. It accumulates quietly and invisibly, year after year, in the form of slightly higher marginal tax rates than were ever necessary. Gradual OAS clawback that chips away at your government income dollar by dollar, and a registered account that keeps growing untouched into a larger and larger tax liability that your estate will eventually have to settle in full in a single year, often at the worst possible rate. So today, we are going through the specific withdrawal strategies that make the biggest measurable difference, starting with the one that creates the most consistent and compounding long-term savings across the full arc of a retirement, which is the tax bracket filling approach, and then moving through the other critical pieces that most retirement planning conversations never reach. The core idea behind bracket filling is straightforward once you see it clearly, but it runs completely against the instinct that most people carry into retirement, because the instinct most people have is to take as little as possible from their RRIF each year, keep their taxable income as low as they possibly can, pay as little tax as possible right now in the present year, and let the registered account keep growing untouched for as long as the government's minimum withdrawal rules allow. And on the surface, that approach feels like smart, conservative, disciplined retirement management. And it is the approach that most people default to because it produces the lowest tax bill in the current year. But what it actually does over time is allow a large, fully taxable account to keep compounding into a larger and larger future tax problem while your lower tax brackets sit completely empty and unused year after year, which is genuinely one of the most expensive passive mistakes a Canadian retiree can make, because those empty brackets represent room to move money from a fully taxable account into a completely tax-free account at the lowest marginal rates you will ever encounter in the rest of your life. And once that room is consumed by mandatory income sources, it does not come back and it cannot be recovered. To put real numbers on what this looks like in practice, consider a single retired woman in Ontario who is 66 years old, recently converted her RRSP to a RRIF, has approximately $340,000 sitting in that RRIF, $60,000 in her TFSA, and is collecting CPP and full OAS that together bring her total government income to roughly $22,000 per year. The first combined federal and provincial tax bracket in Ontario extends up to approximately $58,523, which means she has about $36,000 of room in that lowest bracket before her marginal rate climbs to the next level and every additional dollar becomes more expensive. The standard approach for someone in her position would be to take only the RRIF minimum withdrawal required by the government, which at her age is roughly $14,800, giving her a total annual income of around $37,000, a very manageable tax bill in the current year, and the feeling that she is doing everything correctly. But the feeling and the math are pointing in completely different directions, and the gap between them is where the real cost of this approach lives. The better approach is to withdraw $30,000 from the RRIF instead of $2,800, using roughly $20,000 of that for actual living expenses and directing the remaining $10,000 directly into the TFSA, and every dollar of that $30,000 RRIF withdrawal is taxed at approximately 20 cents on the dollar because the entire amount fits comfortably within the lowest combined bracket. That $10,000 that moves into the TFSA has been permanently transferred from a fully taxable account into a tax-free account at a cost of 20%, and if that same $10,000 had stayed inside the RRIF instead and eventually appeared on a final tax return alongside the rest of the remaining RRIF balance, it would very likely face a marginal rate of 40% or higher, meaning the difference on that single $10,000 decision alone is somewhere between $2,000 and $3,000 in tax that either gets paid to CRA or stays in the family. And if that same disciplined approach is applied consistently for 15 years, $150,000 has been moved from the RRIF into the TFSA at an average blended cost of roughly 20 cents per dollar. The total tax paid along the way is approximately $30,000. But if that same $150,000 had remained in the RRIF and landed on the final tax return all at once, alongside the rest of the account balance, the bill would have been closer to $65,000 or $70,000, which means the bracket filling strategy alone, applied consistently and deliberately over the course of a retirement, produces somewhere between $35,000 and $40,000 in real, measurable, permanent tax savings, and the family receives the entire TFSA completely free of any tax obligation at the time of death. The hardest part of this strategy is not the math, because the math is simple. The hardest part is that in the years you are actively doing this, your tax bill is higher than it would be if you simply took the minimum and did nothing else. And that feels deeply wrong in a way that is genuinely difficult to reason past, because every instinct built up over a lifetime of working and filing taxes tells you that paying less tax this year is always better than paying more this year. But the question that reframes everything is this: would you rather pay 20% now or 45% later? Because later is coming regardless of what you choose to do today. The only variable is the rate at which it arrives. It is also worth being precise about what these bracket differences actually mean in dollar terms across the Ontario rate schedule, because the numbers are large enough that most people find them surprising the first time they are laid out clearly. In Ontario, in 2026, the lowest combined federal and provincial marginal rate on income above the basic personal amount is approximately 20.05%. The next bracket up sits at roughly 24.15%, and above that, the rates climb progressively to 29.65%, then 31.48%, then 33.89%, and higher still as income rises toward the top, and the difference between the bottom bracket and a higher bracket on a large RRIF withdrawal is not a minor rounding issue. It is 15 to 25 percentage points on every dollar caught in that range, and on a $100,000 RRIF withdrawal, the difference in the actual tax bill, depending solely on when and how that money comes out, can exceed $20,000. The way to find your own bracket filling number each year is to add up all of your taxable income from every source: CPP, OAS, any pension, any investment income from non-registered accounts. Then identify the point at which your next marginal tax bracket begins, and the gap between those two numbers is exactly the room you have available to pull money from your RIF at your current rate before crossing into the next and more expensive one. And whatever you withdraw beyond what you actually need for your living expenses goes directly into the TFSA. Within the bracket filling strategy, there is one specific window that produces dramatically better results than any other year. And it is a window that most people waste entirely without ever knowing it was available to them. And that window is the period immediately before OAS begins. Specifically, the 1 or 2 years when you are 64, have already stopped working, and have not yet started collecting either CPP or OAS, because in that window, your taxable income is often close to zero. Your basic personal amount of approximately $16,000 is sitting completely unused, and your entire first tax bracket is available to you at the absolute lowest blended marginal rate you will ever encounter for the remainder of your retirement. Once OAS begins at 65, it occupies some of that room permanently. Once CPP begins, it occupies more. Once your RRIF mandatory minimums begin climbing through your 70s, the window closes entirely and cannot be reopened. Consider the same woman now at age 64, retired, deliberately delaying CPP to age 70, with OAS not yet started, earning perhaps $3,000 from interest in a non-registered account. Her total taxable income is $3,000 for the year. She has approximately $55,000 of room in the lowest bracket. She needs $25,000 for her actual living expenses. She withdraws $55,000 from the RRIF, pays a blended tax rate of roughly 15% on the full amount, uses $25,000 for spending, and moves the remaining $30,000 directly into the TFSA. That $30,000 has just been permanently repositioned from a fully taxable registered account into a permanently tax-free account at a cost of 15 cents on the dollar. If that same $30,000 had remained inside the RRIF until her mid-70s or 80s, when CPP, OAS, and mandatory RRIF minimums are all stacking on top of each other simultaneously, she would be paying 30 to 40 cents on every dollar, and if it remained until her estate was settled, potentially 50 cents or more. The tax saved on that one strategic move in that 1 year falls somewhere between $4,000 and $10,000, and the overwhelming majority of people at 64 sit with almost no income, pay almost no tax, feel genuinely pleased about it, and consider it a success when in reality the empty bracket is not a victory at all. It is a disappearing opportunity that shrinks permanently with the arrival of every new income source. What most retirees significantly underestimate is how dramatically the mandatory RRIF withdrawal percentages increase with age, and how much that compounds the tax exposure of a large untouched registered account over time. At age 65, the minimum withdrawal rate is 4%, meaning on a $300,000 RRIF, the government requires you to withdraw $12,000 that year, whether you need it or not. By age 75, that rate has climbed to 5.82%, forcing out $17,460 from the same account annually. By age 85, the rate reaches 8.51%, and by 90, it hits 11.92%. These withdrawals are not optional and they cannot be deferred, and they will continue adding to your taxable income every year, stacking on top of CPP, OAS, and any pension income, pushing progressively more of your total income into higher and higher brackets with less and less room to maneuver. The retirees who systematically melted their RRIF down during the low-income years in their 60s face dramatically smaller mandatory minimums in their 80s precisely because the account balance is lower, which produces smaller annual tax bills, significantly less OAS clawback pressure, and far greater flexibility to handle unexpected expenses from the TFSA without generating any additional taxable income. There is one final dimension of this strategy that applies with particular urgency to single retirees, and it is almost entirely absent from mainstream retirement planning conversations because the vast majority of withdrawal order advice is designed around couples where income splitting tools, spousal RRIF rollovers, and two separate sets of personal amounts and tax brackets give a household considerable flexibility in managing the total tax bill across two people and two eventual final tax returns spread years apart. When a married person dies, their RRIF rolls over to the surviving spouse completely tax-free and continues to be drawn down over the following decade or two at manageable rates, with the tax spread across a much longer period of time. When a single person dies, there is no rollover available. There is no surviving spouse to absorb the account gradually, and whatever balance remains in the RRIF at the moment of death is added in its entirety to the final tax return in a single calendar year, stacked on top of whatever other income existed in that year, and the combined result of a $250,000 RRIF balance at death is a tax bill approaching $100,000 settled in a single filing on money that took an entire working life to build. This means the goal of the withdrawal strategy for a single retiree is fundamentally different from the goal for a couple. For a couple, the goal is to manage and smooth the tax bill consistently over time, but for a single retiree, the non-negotiable goal is to get the RRIF balance as close to zero as possible before death, and that requires a deliberate countdown plan rather than a minimum withdrawal approach. To put a real plan on this, consider a single woman who is 63, has $320,000 in her RRIF and $55,000 in her TFSA, is delaying CPP to 70, and will begin OAS at 65. Following the conventional minimum withdrawal approach and leaving the RRIF largely untouched. By the time she passes away in her late 80s, there may still be $180,000 sitting in that account, generating a tax bill of approximately $75,000 on her final return with very little remaining in the TFSA. The alternative is a structured drawdown plan with a single overriding objective. Get that RRIF balance as close to zero as possible by her early to mid-80s. From age 63 to 65, with almost no other taxable income and the full bracket available, she withdraws $45,000 per year from the RRIF at a blended rate of approximately 15%, uses $30,000 for living expenses, and directs the remaining $15,000 directly into the TFSA. From 65 to 70, with OAS now part of her income but CPP not yet started, she pulls $35,000 per year and continues directing all surplus into the TFSA. From 70 onward, with CPP added and bracket room tightening, the annual withdrawal adjusts downward, but the RRIF balance is already down to roughly $140,000 instead of the original $320,000. Mandatory minimums are much smaller, and OAS is not being clawed back at all. By her early 80s, the RRIF holds $30,000 to $40,000. The TFSA has grown to approximately $160,000, and if she passes away at 87, the tax on the remaining RRIF balance is perhaps $8,000 rather than $75,000, and the entire TFSA transfers to her children completely and permanently free of tax, with the total difference between the two approaches exceeding $65,000 in real money kept inside the family. Before moving forward, it is also worth addressing one practical concern that comes up consistently when this strategy is first explained, which is the question of what happens if you draw down the RRIF aggressively and then face an unexpected large expense in your late 70s or 80s that you had not planned for. And the answer is that the TFSA you have been building throughout this process is fully liquid, fully accessible at any time for any purpose, without any tax consequence, without any clawback effect, and without any reporting obligation to the CRA, which means the pool of money you have been accumulating in the TFSA throughout your 60s and early 70s functions as a completely flexible emergency reserve that happens to also be the most tax-efficient account you will ever own. And accessing it in an emergency does not push you into a higher bracket, does not reduce your OAS, and does not affect any income-tested benefit calculation whatsoever. The strategy is consistent regardless of whether you are single or part of a couple, whether you are 62 or 72, whether your RRIF is large or modest. Find the gap between your current total taxable income and the ceiling of your current bracket. Fill that gap deliberately with RRIF withdrawals each year. Direct every dollar above your actual spending needs into the TFSA and repeat that process consistently while the window remains open, with particular urgency in the years before OAS begins when the available room is at its widest and the blended rates are at their lowest, and the retirees who pay the least total tax across the full length of their retirements are not doing anything complex. They are simply answering the question of which account to draw from with a deliberate and informed answer rather than a default one. And making that choice consistently over time is precisely what produces the difference between a registered account that quietly compounds into a serious tax problem settled at the worst possible rate and a legacy that stays within your family in the place where it genuinely belongs. This is Wealth Years Canada.